Hey everyone, this is Simply Put on Business Insider and I'm Sriram Iyer. When the economy grows, people make more money and then they spend more money, and that makes prices of other things like everyday items go up. That's called inflation. And right now, as Governor Das explained,
in certain key components like private investment, private consumption, and so a few other sectors which are very critical for the growth of any GDP, we are still lagging behind the pre-pandemic levels.
while the problem of price rise is real, if Governor Das tries too hard to control inflation, it will delay the economic recovery. Essentially, the economy is not growing as fast as the inflation is. And even if you can't read this chart, I'm sure you can feel it every day. To be fair, inflation is not a problem just in India, it's around the world. In many developed countries like the US, the price rise is way more than what they are used to, at least in the recent years.
It will be unfair to compare Indian economics, Indian inflation dynamics to what's prevailing in the most advanced economy, that is the United States. What is United States inflation target and where they are? See the gap between their target and where they are. Other advanced economies also see where is their target and where they are.
So will the price rise get worse if the economy starts growing faster? Man, that would suck, isn't it? But Deputy Governor Michael Patra explains that may not be the case.
Port congestion is unclogging and containers are getting available, so that the much dreaded supply chain bottlenecks, etc., are slowly unwinding. And the sense one gets is that there is what is called a bullwhip effect, that today's shortages will become the surpluses of tomorrow. When finished goods inventories build up in countries and all, at that time when finished goods inventories are led on to the market, there will be very, very little new orders and therefore low growth and low inflation, because there will be very weak pricing power too. Now, coming to your question, as Governor very clearly explained, in monetary policy is for the medium term, not for instant reactions. And over the medium term, as we have set out in our projections, we see a peak in the fourth quarter of this year, and then inflation trending down. And if you look at our projections in conjunction with the monetary policy report, we are going to look at inflation in the range of 4 to 4.3% by the end of 22-23. So I think inflation, the reaction to inflation always involves a sacrifice of growth. And so one must not shoot from the holster, as I keep saying. When you see the inflation hump in sight and the progress of inflation towards the target in view, I think it gives us the space to address concerns about growth, which, as Governor pointed out, is still very weak and needs policy support from all sides.
Right now, the RBI is focused on enabling growth, getting the economy back on track, getting a lot of sectors back to the levels, back to the pace at which they were growing before the pandemic, and not so much on the price rise that pinches your pocket. So you have to focus on planning your expenses over the next 3-4 months, because things are going to get really bad. As far as the RBI's projections are concerned, they tell us that things that are already very expensive, from edible oils to chai, coffee, biscuit, anything that you can touch, the everyday items, they're already very expensive and they're going to get worse in the next 3 months. So you have to plan, you have to brace yourself and pray that the RBI's projections are right and things get better at least starting April. That's all from me here on Simply Put This Week. This is Sriram Iyer signing off.